Introduction to private equity. Do you know what these businesses and many more have in common? At some stages in their lives, they had significant investment from private equity. Private equity is much bigger and more complex than meets the naked eye. It employs hundreds and thousands of people. It had more than $4 trillion of assets under management in 2019. It returned on average more than 10% over the last many years. There were more than 10,000 PE and VC firms in China alone in 2016. It owns thousands of businesses, and in 2018 alone, there were more than 1,000 exits. The term private equity is searched more than 10 million times on internet every year. So what gives private equity the depth and uniqueness to accomplish such performance? First of all is the experience and the strategies developed over many years. Second, are the pre-deal activities, including due diligence, structuring and leverage. Then come the all-important post-deal engagement and exit planning. And finally, supported in the background by robust valuations, unique accounting, and excellent remuneration. Let's now look into the history of private equity. Transactions, similar to private equity, were undertaken to turn around railway companies in the US, in the 19th century. Purchase of Carnegie Steel in 1901 is considered one of the earliest major such transactions. J.P. Morgan paid $15 billion in today's money to buy Carnegie Steel. During and after the World Wars, the US government established different organizations to help businesses. ARDC, founded by Georges Doriot in 1946, is considered one of the earliest VC firms. It invested $70,000 in Digital Equipment Corporation in 1957, which was later valued at $355 million. SBIC, established by the US government in 1958, facilitated funding to VC firms, and thus helped their growth. LBOs also started picking pace in the 60s, while IPOs picked pace in the 70s. Another major incentive was that in 1978, ERISA for the first time allowed pension funds to invest in private equity, and in 1981 capital gain tax was reduced to just 20%. Across the Atlantic, LBOs also started in Europe. The UK in 1981, for the first time allowed target companies to grant security to bidders to acquire their own shares, thus facilitated LBOs in the region. One of the main highlights of the era was the LBO of RJR Nabisco by KKR in 1989, for the value of $25 billion, $51 billion in today's money. The increase in LBOs of 1980s could also be attributed to the establishment of a high-yield bond market. However, early 1990s saw a bust, with the defaults of many high-yield bonds, thus limiting the growth of LBOs. Late 1990s saw another resurgence, with the false dawn of the dot-com bubble, so did mid-2000s, ending at the financial crisis of 2008, when IPOs dried up. Fundraising picked pace in 2010s, and 2018 exceeded the pre-2008 levels. In 2020, is there another bubble in the making, like 1990s and 2000s? One positive is that the firms have a lot of dry powder, and can take advantage of any market downturn. There is also a buoyant secondaries market, and regulatory supervision has increased. However, there remain concerns about fees, and whether the overall private equity returns are any better than the stock market. The global economic environment, and its impact on IPOs and leverage, also remains a big question. A huge dry powder has also meant huge valuations at acquisitions, which could result in losses on exits. Is this time really any different? Having discovered the history, now let's look at the strategies employed by private equity. There are many strategies practiced by private equity firms, which can be grouped by stage, ownership and purpose. Venture capital is one of the main ones, where firms invest in early-stage high-risk companies that promise high returns. Buyout is another main strategy, where firms take controlling stakes in companies to achieve a particular result. Growth capital involves firms investing in companies to facilitate growth initiatives. Turnaround is where firms invest in distressed or special situations to return companies to profitability and/or liquidity. Mezzanine capital involves providing subordinated debt at higher interest rates so companies can hold on to equity. Acquisition capital provides capital to companies that intend to grow through acquiring other companies. Consolidation involves acquiring various targets and merging them to form one large company to realize synergies. Employee ownership plans help employees buy their own companies by providing equity capital. Corporate divestiture involves buying a division of a large corporation that is being spun off. Recapitalization involves providing equity to partially cash out one of the owners. Shareholder liquidity is similar to recapitalization, but involves complete cash out of an owner. Finally, there are private equity funds, whose strategy is to invest in other private equity funds. This is to diversify risk, or to provide a secondary market. There are even more strategies out there, and each firm practices something different. Having looked at the history and strategies, now let's look at an actual transaction, and start with due diligence. Due diligence is an essential activity in an M&A transaction, and involves verification, investigation, or audit of a potential deal. Main reasons for due diligence include, to confirm and verify information that was brought up during the deal or investment process, also, to identify potential defects in the deal or investment opportunity, and thus avoid a bad business transaction, plus, to obtain information that would be useful in valuing the deal. And finally, to make sure that the deal or investment opportunity complies with the investment or deal criteria. So, what is the process? Before the due diligence process begins, the PE firm writes a letter of interest to the target company, and an NDA is also signed. Main areas of focus during due diligence include target company overview, financial statements, and other financial information verification. Considerations of strategic fit, technology superiority, and production capabilities. Assessing credentials and achievements of the senior management team. Market study of current customer base, its loyalty, and potential of expanding and scaling it. And also, in-depth checks of legal and corporate matters, including any environmental issues. Due to the complex nature of due diligence, PE firms engage a team of legal, financial, and other relevant experts to carry out the work. Due diligence is a very time-pressured exercise, where multiple PE firms may pitch against each other, and despite the huge costs involved, many do not end up in a successful sale agreement. Let's now talk about structuring. Soon after a deal is finalized, its structure is finalized as well. However, the structuring of a PE fund happens much earlier, so that money can be raised from investors. Legal structuring of a private equity fund, and its investments, is one of the most important stages in the life of these vehicles. In terms of structuring a private equity fund, the key aim is to keep these funds as secure, efficient, and transparent as possible, and also to meet any specific requirements of investors. The first consideration is to use a fund vehicle that suits the life cycle of a fund, and the default choice has been to use a closed-ended vehicle, with a life of 10 years. It is also very important to keep the fund vehicles as tax transparent as possible, and a jurisdiction with tax transparent structures, and a wide network of double taxation agreements is chosen. It is also important to choose a jurisdiction that has a stable regulatory regime, where costs of operations are low, and where necessary service providers are available. Some investors may also have a preference for a fund to be based in a regulated jurisdiction. This is to ensure that investor money is safe and also to comply with their internal policies. Sometimes all these qualities cannot be found in one jurisdiction or vehicle, and thus a master feeder, or a parallel fund structure is used. All these matters are documented in the constitutional documents of a fund, including the private placement memorandum, and the limited partnership agreement. Main fund jurisdictions include the US, the UK, Luxembourg, the Cayman Islands, the Channel Islands, Hong Kong, and Singapore. In addition to the fund, it is also important to structure the investment transaction correctly, to ensure security for lenders, limited liability for investors, and full repatriation of any sale money later. In reality, the structuring of a fund and its investment transactions could take many months, and could cost hundreds of thousands of dollars. They also require coordination between many parties, including the fund manager, investors, lawyers, accountants, auditors, bankers, lenders, sellers, regulators, and many more. Having talked about legal structuring, let's now talk about financial structuring and the use of leverage. Leverage is extensively used in private equity, and it is not rare to find transactions financed up to 50% or more through loans. One reason is because loans are repaid before equity, thus cost of debt is lower than equity, resulting in higher returns for the investors. Also because interest payments are tax deductible, and hence reduce tax liability of the targets. Use of leverage also brings financial discipline to the targets, as fixed payments are required regularly. Targets stick to a strict operational plan. So, what is the downside? Due to use of high leverage, private equity firms sometimes take higher risk, compared to if only equity had been invested. Since these loans are secured on the assets of the targets, many of them go bankrupt during an economic downturn. Another criticism is the use of borrowed funds to make distributions to investors, which is called asset stripping, and is now being regulated in many jurisdictions. Although use of leverage is heavily criticized, it is still being widely practiced in private equity, and is also increasing at fund level in the form of longer-term bridge financing. Let's now talk about the actions undertaken by a PE firm after an investment is bought. Soon after buying a target, PE firms straightaway engage in activities that aim to increase the value of the company at exit. The two main elements of this initial engagement are first to properly incentivize the management, and then to implement a 100-day plan. Incentivization of management includes introduction of a share option scheme for key employees, linked to the value of the company at exit. Shares under such schemes are required to be bought by employees from their own money, so that they remain committed to the company till exit. The 100-day plan. The activities in the 100-day plan lay the base for all the hard work that is required to be done till exit, to achieve the desired outcome. These activities, first of all, focus on the design and implementation of a sound corporate governance structure that can support the other measures in the plan. Then comes the finalization of the long-term strategy of the company, and if it will focus on scale, acquisition, or processes, etc. Next comes the identification of issues in the current setup, which could be matters in relation to HR, capital, sales, culture, profitability, etc. Once the strategy has been defined, and the issues have been identified, clear goals are set to be undertaken till exit. Checks and balances are then brought in to monitor those goals. These generally include devising a robust reporting system, introduction of relevant KPIs, and setup of a program management office to meet those goals. From there on, the main activity is to monitor progress, and to update the goals for any changing circumstances. While PE firms are always preparing for an exit, exit-related activities increase as soon as the company nears the achievement of goals set out in the 100-day plan. Each PE firm has a different style of operating. However, it is generally noted that companies owned by private equity are better managed, and PE firms do not interfere in the day-to-day operations if the management is capable of running its own affairs. Let's now talk about exit itself. Exit from an investment is a very critical decision for a PE firm, and a wrong step could mean compromising the hard work of many years. First consideration is to see if the investee company is ready for an exit, i.e. if it has attained the stage where it can successfully move to the next stage in its life, and the processes are in place to support that transition. It is also important to determine if the market conditions are right for an exit. Lack of demand for any reason could mean an incorrect timing. Presence of the right buyer in the market is also very important, otherwise a sale may not achieve its set objectives. All these considerations translate into a high valuation, which is the prime purpose of the exercise. So what are the avenues? While exit valuation is the prime motive, it is also important for the brand of the PE firm that the investee company performs well in the future. The most common avenue for a sale is an outright sale to a buyer, who could be a competitor, another PE firm, or a large corporate, etc. When the investee company is too big to sell to one buyer, then the only option could be to list it in an IPO. This could command a higher valuation, as investors can benefit from the liquidity in the stock market. Sometimes, an investee company is sold to another fund of the same PE firm. This is where the conditions for another type of sale are not right, but the fund that holds the investment is nearing to the end of its life. At times, the investee company is sold to its own employees. This may be at the request of management, who may borrow money or introduce a buyer in the process, and may also realize some of their own shares. Similar to a leverage buyout at start, sometimes money may be borrowed at exit, to buy equity from the PE firm as a form of exit. In a distressed situation, the only option may be to liquidate the investee company, and to sell the assets in a piecemeal fashion. Exits are such an important stage in the life of an investment, that PE firms plan for them even before buying an investment, and start preparing investee companies for exits soon after buying them. Successful exits are moments of joy that deal professionals cherish even many years after the sale transaction is complete. Now, let's look at some of the support processes, and let's start with valuations. There are many reasons why accurate valuations are of paramount importance in private equity. One is to set a baseline value for a business, and develop a strategy to improve its profitability and increase its value. Another is at the time of obtaining loans, to guarantee security to lenders. At the time of offering shares to employees, is another important event. Periodic financial reporting is one of the most frequent uses. In the event of liquidation, is another requirement. But by far the most important one is at the time of exit, merger, or introducing new capital into the business. So what are the methods? There are many methods of valuations in private equity, but there are a few main ones. PE ratio is a widely used method, which multiplies profits with industry prevalent multiples, and is used for stable companies. Another widely used method is DCF, where future cash flows are discounted by applicable cost of capital. It's used to value stable companies as well as startups. Looking at prices of comparable transactions is another method, but is dependent on the happening of a recent sale. Entry cost model is another method, which looks at setting up a similar company from scratch. Asset valuation method focuses on valuing of individual assets, and is mainly used by liquidating companies. In essence, however, it's a mix of many factors that produces a valuation, and also depends on supply and demand. Valuation is a hugely contested topic in private equity, and there is never a right answer to what amount a company should be valued at. Now let's look at the other support function, that is accounting. While private equity has similar accounting and reporting concepts, such as accruals, valuations, IRRs, etc., there are some aspects which are unique to private equity. Some of the main differences stem from the fact that investors may join at various points in time before the final close, and may also have different investment preferences. To treat all investors equally, in sharing of investment returns, concept of equalization is used, where new investors pay equalization interest to old investors. After this, rebalancing is performed, and all income, expenses and balances are divided between investors in the proportion of their invested amounts. Private equity investors may also have various preferences in terms of investments and percentage of fees they pay, and thus all their individual records are maintained separately. Money is drawn down from investors at different stages when investments are bought, and is distributed back when they are sold, requiring further recording. Another unique aspect of private equity accounting is calculation of management fee, also known as general partner share, or priority profit share. Management fee is calculated as percent of committed amount during investment period, and as percent of invested amount during post-investment period. However, arguably the most well-known aspect of private equity accounting is the calculation and recording of carried interest. The inputs in carried interest calculations include value of investments, date of drawdown and distribution, the minimum hurdle rate involved, the compounding of the hurdle rate and the deduction of fee already paid. Carried interest could be realized on whole fund basis or deal-by-deal basis. Recording of unrealized carry-on or off-books is a much debated topic. Due to these unique aspects of private equity accounting, many specialist software programs have been developed in the space, and also many specialist firms provide these services. Now let's look at the last topic of this video, which is remuneration. Handsome remuneration is one of the main reasons why private equity attracts the best talent, and thus higher returns. Private equity firms earn remuneration in many ways, the main one being management fee. Management fee, which is charged for running operations, can range between 1% and 2.5%, and is calculated on committed or invested capital. Private equity firms also charge investors a percentage of profits, which is called carried interest. Carried interest ranges from 15% to 20% of excess returns above a hurdle rate, which is pre-agreed with investors. There is also a third source, which is charging portfolio companies a management fee. It is expected by investors that such fees, if charged, are properly disclosed and are offset against management fee charged to investors. There are some matters in relation to remuneration, however, that keep private equity in the headlines. One is in relation to the returns that private equity earns, and if they are actually superior to justify a higher fee. Another is in relation to institutional investors, and their ability to understand how much fees private equity firms have charged them over the years. And finally, in relation to taxation of carried interest, and that many a times it is treated as capital gain, and attracts a lower rate of tax. To find out more about all these aspects of private equity, watch our other videos.